Welcome back to the Global Ledger. I'm Justin. Today's episode is part of our Mythbusting series, where in the past we take the most common beliefs in finance, kind of try to slow them down and rebuild them from the balance sheets up. And today's myth might be the most widely believed. I've heard this a lot. The Fed props up the stock market, or every time stocks fall, the Fed steps in. QE exists to save equities, or the Fed cares more about Wall Street than Main Street. You hear this from retail investors, crypto commentators, macro influencers, politicians, and professional traders even. And it feels true because stocks often rise when the Fed acts. But that intuition is misleading. So today we're going to separate what the Fed actually does from what markets do as a side effect. Let's get into it. Let's start with why this belief is so persistent. Every time there's a crisis, 2008, 2020, 2023, regional banks, the Fed intervenes. Liquidity appears, then markets stabilize and stocks eventually recover. So people draw a straight line from Fed action to stock market support. But that line skips, I think, the most important step in the middle. The Fed does not target asset prices. The Fed targets market functioning, and those are not the same thing. The Fed is actually responsible for what? That's the question. Here's some key distinctions I think people miss. The Federal Reserve is responsible for payment system stability, bank funding continuity, money market functioning, and settlement integrity. The Fed is not responsible for equity valuations, P multiples, earnings growth, investor sentiment. When the Fed intervenes, it intervenes at the plumbing level, repo markets, reserves, collateral flows, interbank funding. It acts when markets stop clearing, not when prices stop rising. Markets can fall 30% and still function perfectly fine. The Fed steps in when dealers won't intermediate. They step in when funding evaporates and settlement is at risk, most importantly. That's a very different trigger than stocks are down. So why do stocks still rise even after Fed action? And this is the confusing part, I believe, where people get caught up. If the Fed isn't propping up stocks, why do stocks often go up after the Fed intervenes? Because stocks are downstream of funding conditions. That's why. Very important. They are downstream of funding conditions. So when the Fed stabilizes repo or restores dealer balance sheets or ensures money markets clear, it reduces the probability of forced liquidation. That doesn't mean the Fed wants stocks higher. It just means that the Fed doesn't want the system to seize. Once forced selling risk is removed, investors reassess risk, extend duration, reprice assets. And so that's not like any kind of stimulus effort. It's damage control in a lot of ways. So stocks rising afterward is a second order effect, not the objective. QE is not stock market support, no matter what anybody says. This is where the myth really hardens, I think. People hear QE and think money printing, asset pumping, and stock bailout. But QE is an asset swap. The Fed removes duration from the system, replaces it with reserves, and that changes balance sheet composition, liquidity profiles, and collateral availability. It does not inject spending power into households, mandate buying of stocks, and guarantee equity returns at all. The reserves don't leave the banking system. They don't chase Tesla shares or bid up the S&P. QE changes who can fund what, not what must be owned. Very important point. So this confusion is kind of dangerous, though. So believing the Fed props up stocks leads to bad conclusions, like the Fed can't let markets fail or fall. Risk is socialized forever, or the Fed put is infinite. If we've heard these before. So history says otherwise, okay? The Fed allowed the dot-com crash, the 2008 equity collapse, the 2022 bear market, okay? The Fed allowed this. What it won't allow is payment failure, dealer collapse, and money market dysfunction. Those are different things. Equity pain is allowed. Systemic breakdown is not. So the Fed put is not what you might think, okay? People love the idea of a Fed put. But the real put is not under stocks, okay? It's under settlement, funding, and collateral liquidity. If stocks fall because earnings disappoint, valuations compress, or growth slows, the Fed does nothing, okay? If stocks fall because repo breaks, margin calls cascade, or dealers step away, then the Fed intervenes, not to save stocks, but to save the system that clears them, okay? Really important distinction. Really important distinction. So I guess the question is, who benefits? And again, this may sound a little uncomfortable, but if the Fed isn't propping up stocks, why does it feel like asset owners always benefit? And that is because financial assets reprice faster than wages. Funding stabilization helps leveraged actors first, okay? And asset markets are closest to the plumbing. That's not favoritism, okay? That's the plumbing, that's the structure. It's a consequence of how money flows, not who the Fed likes, okay? So here's the myth we're busting today. The Fed is not propping up the stock market, okay? That's the myth. What the Fed does is more limited and way more important. It keeps the financial system from breaking. It preserves settlement and funding. It acts as a dealer of last resort, not portfolio manager. Okay, stocks may rise afterward, but that doesn't mean they were the target. Okay, if you want to understand markets, stop asking what does the Fed want stocks to do. Okay, start asking where's funding stress, where's settlement risk, and where would forced selling start. Okay, so I want to thank you for listening to Mythbusting episode 3. We tackled that the Fed is not propping up the stock market, and we will continue to tackle these misconceptions and these myths that seem to spread very fast, very wide. So I'm Justin, and thanks for being here.